Welcome, everybody. I see the numbers climbing. I'm J.Thelander. I'm going to be your host for today, along with Jessica and Steve. We're going to talk about corporate venture compensation, what we're seeing in the market right now, some trends, and it's meant to be interactive. So we welcome your comments and questions, and we will respond to those and incorporate that into our discussion today. I'm going to kick off with a little bit of a CVC sort of market overview. We are partnered with PitchBook here at Thelander, and PitchBook published an article recently saying that corporate venture capital has been an undisputed force in the US venture ecosystem. And since 2014, so that's 11 years ago, it's accounted for more than 46% of total VC deal value and 21% of deal count. So that's massive capital. And unfortunately, the only negative side of that is that CVCs haven't converted many of those portfolio companies into acquisitions. So we'll get a little bit more into detail to talk about what the strategies are for CVCs and how that impacts compensation. So I'm going to turn it over. Jessica, why don't you give us a little bit of your background? And we're really glad to have you here today. I know we've worked together for years.
Yes, well, great. I really appreciate being here, and I think, Jody, we've worked together in the various aspects of roles that I've had. I am a managing partner with Echo Health Ventures. We are a strategic investment arm that invests on behalf of 4 different Blue Cross Blue Shield plans. So we call that our alliance. And this is a very unique structure in that we are not a true corporate venture capital where we're under one tent, but we're also not all the way over to be a traditional institutional investor. Before I joined Echo, I was with GE Ventures. That is about as down the line CVC as you can go, with still having a dual mandate, which many of the CVCs do, of returns as well as strategic impact. But it was very much a CVC. Before that, I was with a fund called Lemhi Ventures, with United Health Group being one of our very large LPs. So not as strategic, but it was actually an institutional structure. And then you go way back, my very first investing job was actually with a family office. And so we called them merchant banks at the time, though, with a place called Green Spring Advisors. So through these different opportunities, I feel like there's been decisions that I've made and opportunities to see how this industry has also evolved over the last 25 years. Really looking forward to the discussion. Thanks, Jody. And I'll
pass this on to Steve Flores, partner at Cooley. Hi, Steve. Nice to have you. We met because we worked together on a couple of CVC projects. So tell us about your role at Cooley and your client base and your area of expertise.
Sure, absolutely. It's a pleasure to be here with you. So Steve Flores, I'm a partner at Cooley. I work on anything compensation and benefits related, including in a variety of different corporate transaction contexts. I tend to work with a variety of clients, from operating companies to fund sponsors, venture studios, CVC units, family offices. So I think that variety of expertise comes in really handy in this space because, I think, as you'll hear from the discussion today, there is no kind of one size fits all. It really is, I think, very unique in that way, in that you draw from very different areas, just based on the history, the goals, and various other issues. So, as Jessica mentioned, her variety of roles, I'm sure, have been incredibly valuable, and just kind of seeing how all those different, sectors think about compensation.
Yeah, well, I couldn't agree with you more. That's sort of the flavor, is that there is no one way. It's like going to Baskin Robbins. There are 31 flavors and more. I'm going to jump into a little bit of data because we know everybody likes to see all of this. So, and we have some fresh data on salary increase and bonuses, and also on what the plan is for hiring. So we at Thelander are a compensation data and consulting firm. All of our data comes real time from our platform, and it is a give to get model. So if you participate, you get access to a subset of the results for no charge. That's sort of been our secret sauce. And I know Morgan on my team will go ahead and put a link to the survey here in the chat so that those of you who haven't participated. And don't worry, everything is anonymous. We share no individual names or data. And we've had a nice run being featured in particular in Forbes magazine, even today on the venture industry. It was an article about pitch book data, and they had a quote from J.Thelander about where the women are in terms of being VCs and at the top levels and what the trajectory is. It's a little better in CVCs. And then we had a story last week or 2 weeks ago. So that's been great. And we're really proud of the fact that our data has been featured. And we would, again, love for all of you to participate. I'm going to keep putting that plug in because everyone wants the data, but it's better if you participate because representation, you're a smaller group, but very mighty as the numbers show in terms of your participation in deals in the whole venture ecosystem, as both Jessica and Steve said. So it's really important that your data is included. So here's a little bit of background, right? Here's all the types of investment firms. And Jessica, you mentioned this with the family office because there's been a lot of uptick in family office questions. And it's because there have been so many successful founders who now it's no longer called merchant banking. That's for and they have become very active investors in the whole ecosystem as well. And the compensation can be a mix of the same thing for a CVC because the money's coming from a family, so you don't have to raise the fund. But you can see we have 18% CVC, 44% venture, and then these other areas where the compensation is really trending to be very consistent at the mid levels down and at the top levels, like Steve said, there's no two ways. We look at a lot of the compensation by assets under management. And Jessica and Steve, do you have an opinion on this? Like, do you find that the CVC really does matter how they're structured, or the assets under management is more important?
Absolutely. I think the one of the things that I would encourage anyone who's, if you're on this panel, you're interested in this topic, to really look at and understand the maturity of the organization. If you say, and the difference that we're talking about in terms of what is a true CVC and then what is a carved out with its own potentially evergreen structure. And that means that it's bringing back its own, and you have to return capital to be able to put capital back out to work. But that those structures are put in place over potentially 10 years, and that the parent entity or the owner of the entity knows how those cycles work, when to put money in, and that the money is there for the follow-on investments.
Well,
so
the assets under management can matter, but the reality is that because we had a question, and between the two of you, you probably have a good answer for this, is how are CVC investment groups typically organized and what size teams are typical? I already know there's no what size teams are typical because we on the consulting side work with a team of one that then will be growing. But Steve, you have a thought on this, and Jessica?
Yeah, well, I think that obviously that makes a big difference, right? Your AUM and how many people you have within your organization. The more mature you are, you tend to have obviously larger groups. And as kind of, we've seen in some of the projects, that then translates into, a little bit more sophisticated compensation strategy and perhaps divergence, between your kind of higher level more sophisticated folks and your support folks or more junior people. So I do think it has a big impact.
Well, let's face it, all CVCs start out in some way where they're really excited to invest. And then you hit that sort of plateau where they're excited to invest and they feel like in order to attract and retain people that are coming from outside of the parent company, then all of a sudden you get into a discussion of carried interest or what are the other long-term incentives. So invariably, it begs the question, how do we structure, at what point, how many people do we have to have where they're able to be organized to have more of a formal structure that may be separate from the parent company? So I'm going to go back to sharing my screen because these answers are require all of our expertise, but certainly having data is very helpful around this. So we talk about the assets under management, and Steve, I would agree with you, and I think Jessica, you agreed as well, that the higher AUM classes tend to have more formality and structure because you're dealing with a lot of money. And you can see here, we used to have smaller AUMs, and that sweet spot is sort of in that 100 to 250, 250 to 500. But you can see that we're almost up to 20% in that 500 million up to 2 billion plus. And that's because of CVCs that have been around longer. And this goes to how long has the current CVC been in business? And you see these longer CVCs, they have a different comp structure and protocol than those that are emerging. And Steve, I know you work on this sort of fund formation and what happens. So talk to us a little bit about what the criteria is. And Jessica, I know you know this from firsthand, but what if you're a starting out CVC, what are the kinds of things you should be looking at versus a later stage CVC that's been in business and is hitting different peaks?
Sure. I guess the starting point is always, when I have discussions with clients in the CVC space is obviously we're competing for talent, and, the folks we're trying to draw from are folks who are fund professionals, right? So, they're accustomed to base, bonus, carry, co-investment opportunities. That's often the starting point, right? And then we go from there to kind of look at, okay, how are you organized as an organization, right? And that can create opportunities, and also.
And do you mean about what's the structure of the fund?
Well, the structure of the CVC itself, right? So either within
Here,
a
maybe this will help
company,
out.
or
If I don't know if this is what you're talking about, but if you are, I'm going to let you talk to this slide. So this is the different ways that a CVC can be
Yep.
structured, and this does
Yep.
impact the compensation structure and organization. So
Exactly. So when I think at very inception, when I'm talking about structure, I mean the actual entity itself, right? Before you even start, I'm thinking of a corporate entity, whether it's structured as a C corporation or LLC, and the various
right.
different compensation structures that apply to each of those. There's also, I think, as a entity matures, there's also, the sometimes a desire to set up, special entities within the organization to be able to provide, carry, for example, or other opportunities that are not necessarily there, with kind of more earlier stage CVC, where we tend to see more, a lot more. We see cash throughout, but
Right.
we see more cash on the earlier end for sure.
Jody,
Yeah.
why the data you had up was so interesting is because it ties into.
This is my favorite chart, because whenever we do consulting, no matter what, we always look at compensation by these different structures. It comes up every single time because it does impact, and you can imagine, and Jessica, you can speak to this. Tell us from your experience, obviously, the more independent you are, the more that the long-term incentives can be part of it.
So this comes back to intent also of, if you're investing in an early stage company in the healthcare sector, you may be waiting 7 to 10 years to get that payout. In the venture, at least 4 to 7. And in private equity, you're looking maybe more at 3 to 5 years. But you start stacking these up and you deploy over maybe 2 years to up to 3 years into new investments. You're looking at a cycle of investment that really needs to take 6 to 10 years.
Right.
So unless the entity is set up in a sustainable way, in a way that is going to actually help keep those individuals there through the exit process, sure, people can do deals, like they can do a follow-on, but it is that following is when you get the returns. How are you doubling down on your winners, et cetera? That's where you actually get the IRR back to the entity. And I think that long-term view is what really matters, and why that graphic always comes up.
Yeah, I'm going to go back to the tables for a minute. And we've had some other questions, which I just want to make sure we're seeing, but I'm going to couch this because I think it's important to make sure that we're all coming from the same understanding here at the ground level. So this is the different structures of the investment fund, right? And with the different structures, that impacts the long-term incentives. And the just so you know, by way of background, that we cover global compensation here, and we are able to compare and contrast, and that's also on our platform. You can run by custom filters. And the other part of the platform, which is so great, is we have all the investment firm compensation, which is the VC and private equity and family office. So it's two different sets of questions, right? Because we know that the fundraising in and of itself has a different impact on the compensation. But that within the US, the CVCs are located all over and doesn't really impact compensation because talent's talent, and we're seeing this more than ever. And then here is also within Europe. And then this is the list of positions, which I think is important to acknowledge. This is the list of all the investment firm positions. So we have 6 levels of investment professionals, starting from the associate all the way up to someone like Jessica, who's a managing partner, the bosses, and we have now a lot of other roles that the VCs have taken a page out of the CVC playbook, and that there's a lot of supporting roles for business development, portfolio services. And now there are multiple levels of it, VPs, directors, and managers. And it didn't used to be the same, even asset managers. And then here are the investment firm positions for corporate venture units, which also has changed. I think when I started doing this, we had 3 or 4 roles, and that's even grown here. So that portfolio venture, business development role has expanded to multiple levels, investment program managers. We've expanded senior investment professionals from 1 level to 2. So there's a lot of compensation that goes into it because, Steve, you were touching on this. The CVCs are really growing. So I'm going to move from this data into the long-term incentives. I'm dying to show the new data on the salary increase and bonuses and hiring for 2025, but I am going to go to the CVC compensation and long-term incentives because I know everybody wants it. I try to start differently every time, but it never goes that way because we want to get to the good stuff first. Okay, so here's the CVC unit structure compensation and the impact on long-term incentives. And Steve, I know we've used this with a shared client before. So, and Jessica, I'm going to let you talk us a little bit through this. I think you've used every single one of these in different roles that you've had. So talk to us about these different, compensation levers.
So I think for people on the call, they're going to truly understand what a corporate stock, that is not going to be available in the same way, and the stability of that. As again, from a GE Ventures perspective or something like that, you say, okay, I'm getting GE stock as well as something else. That right. And I'm going to punt to Steve a little bit in terms of some of this is nuanced because if you are a nonprofit, that may have some other aspects.
I was on a call yesterday with a client and they were working with them on their long-term incentives because it's come up, but they're a sort of corporate venture firm, but they're private. So they don't even have corporate stock. So they have a profit sharing distribution. So actually that's something that we need to add in here as a different lever as well, other than incentives. So, but
but I think as anytime you're looking at compensation, you're looking at a total package of what is the short term, what is the long term, and I think one of the differences in CVCs that one would need to look at when looking at these is when you're looking at institutional and the carry, that payout may or may not come 5, 7, 8 years from that, and you really need to do the analysis of what does a larger bonus potentially mean year 1 versus that. And these are numbers that anyone who's entering this field should be able to run very, very clearly. And, I think savvy CVCs are trying to mimic it as much as possible, but there may be some time value difference.
Well, they're trying to mimic as much the venture, but we know that that's tricky because you're not raising a fund. And in addition to that, you're not contributing capital for your carried interest if you have it. So in most cases.
Right, exactly. The time horizon is different, right? You can, even as a private company, issue stock options, but typically when we do that, the expectation is, look, I'm going to get a liquidity event down the line, which is either going to be a transaction or it's going to be an IPO. So, for a private company, it gets difficult, I think, to incentivize folks with private company stock. Obviously, if you're a public company and you have a CVC unit, then there's liquidity there. So there is, more common, you would see, RSUs or options also issued to investment professionals. So that's, we kind of talked a little bit about, the fund has very specific types of incentives that I think are very attractive,
Let's
very
talk
tax
about the
efficient.
different comp levers. Maybe you can walk us
Yeah,
through this and we can do this together, Steve. So
sure.
the cash compensation for a typical CVC employee is base pay. They get some kind of bonus. We look at that both as current bonus, meaning it was paid, as well as what the target bonus is out on the horizon. And most CVCs look at this as a percentage of base pay, and we have that as well. And then the other incentives, just by definition. So you mentioned a couple of things very quickly, and I want to make sure everyone has the same understanding of this. So corporate stock can be restricted stock. It can be, what are the different options there?
Sure, it could be restricted stock units, which are essentially a promise to deliver shares down the line. It can be an option, depending on the structure again of the entity that's granting, right? So in an LLC, it could be capital interest, profits interest, unit appreciation rights, things along those lines, depending on the structure.
Right. And then the other good stuff, which Jessica, we can talk about, which is okay, so once you get out of the corporate stock, which really everyone I think who is getting it has a pretty good understanding. And the nice part about it is that it's really consistent. And while it may not be, hurdling the bar, it is definitely steady. And as Jessica said, and our J.Thelander data shows on the investment firm side, that the vesting times for carried interest used to be typically 5 to 6 years, which we still see in some cases, but we're also seeing a very big increase for vesting times being over 10 years.
Mhm.
And so that's not a return happening anytime quickly. And so some of the inflated salaries for investment professionals and venture firms is great, and the numbers look very robust. But the reality is there are capital contribution calls made all along the way. So that's just as an aside, but let's finish with this slide so we finally finish something without jumping around. So the shadow phantom synthetic carry is a version of carry, and it's based on some point where you are a starting point and an end point, and it's the difference between those two that you get as a shadow phantom synthetic carry. And Jessica, you've had experience with it, and Steve, maybe you could explain the logistics of it.
Sure. Jessica, do you want to go first?
No, I was going to have you because I think the logistics are important first.
Yeah.
Okay. Yeah. So the good thing about shadow carry, phantom carry, synthetic carry is that there's a tremendous amount of flexibility in terms of structuring the economics, right? You can do it year by year. You can do it deal by deal. You can do it for, a specific term. You can add whatever vesting conditions you want in terms of service requirement. You can also add, for example, if you want to have a particular hurdle return, right? If you want to add some component of operating expenses whenever you're figuring out, okay, we've received enough, from our investments in order to be able to distribute some of those proceeds through the synthetic carry program. Some kind of basic things that I think, if you're establishing one of these programs that you should really keep in mind. One is you want to make sure that the achievement of whatever hurdle you've set aligns with the cash that the CVC is going to have, right? Because this is a cash payment that you need to make. So you want to have liquidity. So for example, if you receive equity, when you're exiting, right, that shouldn't count as part of the payment that you need to make out. Similar, if your investment, if your portfolio company goes public, right, you want to wait until you sell those shares and have liquidity in order to have that commitment to then
Right. So it's not one
distribute
way.
that.
Here's how the shadow, one's a slide on it from the data talking about how is it calculated. And it could be a change in the fair market value of the portfolio only, or it could be a percentage of the return from the portfolio exits after a corporate hurdle rate. And that's not different from a VC has to have, with the 80-20 split, then they have to have a certain rate that they have to of return before that you can go ahead and get your carried interest distribution, meaning that the investors, the LPs, have to get their money back.
I think a couple other points that I do want to make quickly. One, tremendous flexibility where we run into issues time and again is when people want to leave. So because it's cash, it's deferred comp, we have to consider Code Section 409A, which restricts our ability to continue to pay people after they leave. Now, there's ways to set things up, but it's very difficult and complicated to do. So that's one area where we run into not only just in terms of pushback from clients, from the investment professionals themselves,
Right.
but that's one, you do
That's
have to
the
be
sort of,
present.
you have to be present to win.
Yeah.
Exactly, exactly. Which is difficult, right? We just talked about the time horizon, which is can be 10 to 12 years, right? It's incredibly hard to get people to stick around and think
Well,
that's
that's a
really something
huge
valuable.
factor. I mean, we're hearing this more and more and more, right? Because as this relates, and Jessica, you can speak to this, there is dry powder that VCs have, but they're not deploying all this capital across a lot of little investments anymore. They're putting more into portfolio companies that they feel like are going to have an exit, even though companies now have raised over $300 million. We look at companies that have raised over $500 million because the M&A and the IPO market is quiet, or M&A probably less quiet, but regardless, they're not seeing big returns yet. And so everyone's being cautious. And
Mhm.
even though they may have the money from the parent company, or the VC has money from the LPs, it is not being deployed in any, it's not this, highly active environment right
Mhm.
now.
Yeah. And this comes back to when an individual looks at joining a fund or a CVC or any type of institutional funding mechanism. What does it look like to stay for the long haul at that
Right.
organization? And do they have the legal documents to back up all the things that they're telling you? And I think that if that's a piece of advice I can give to the
Yeah, what
audience,
would you
that
say? What should you be looking at?
making sure that you understand the compensation structure in detail,
Right,
and making sure aligning with the maturity of the organization. It may not be all written out. If
right.
it's not all written out, expect the executives may change. Expect all of this may change over time, and happens in CVCs. It's a new CEO, it's a new board. They're not going to do it anymore 4 years from now, and what you thought was in place isn't there anymore. So Mick and Steve can talk a little bit more about that. But if you must be present to win, and it changes, what situation are you in then? And so I think going back to who are you working with, what is the maturity of it, and do you have the time frame that you want for your career to be signing up for this? Because there's great opportunity, but just be eyes wide open on all
It's
of
a long
these.
game. And even on the
It's a long
ventures,
game.
I think there's been this misnomer that everyone's getting rich fast, and that's just really not the case. I'm going to make sure we stay on track with getting through a couple sections. Otherwise, I feel like we're moving around a lot. So we got the levers, the comp levers, and we know a true carried interest, which is a little different in a CVC, in that because you're not raising the fund, it's an adjusted version from a true carry inside of a venture firm. But let's look at because this question came up, what are the additional incentives in addition to base pay and cash bonus? And we looked at how you structure the shadow phantom carry. There can be some hybrid situations. And here it is by the less than $250 million of capital under management. And you can see that we've got this data nicely over a couple of different years. 23. That's the only benefit of having been doing this. I've been in this business now almost 30 years, and we've been doing this CVC survey for about 10, and the VC survey for about 20. So we do have historical data. And you can see that this carried interest only, though, has been on an uptick because, true to Jessica, what you're saying is that, and even Steve, you mentioned it, although from a different angle, but we see it also, is that it comes up all the time. Every investor, if they go to a CVC, is like, great, I love the corporate stock and the consistency. And I love knowing that I have all of the infrastructure coming from the parent company in terms of business development and resources and, actual expertise. But the reality is we want to get paid like our VC counterparts because we want skin in the game. We're not investors because we don't care about the success of the portfolio. To the contrary, we want our compensation tied to it, even if it's going to be a long haul.
Yeah, absolutely. And there's challenges, right, with being able to provide carried interest, right? There's additional, I think, administrative and um, 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 uh, and kind of just setup expenses. If you want to be able to provide carry, you have to set up a vehicle, right? And carry is basically a profits interest from a partnership. So if you don't have that set up in place and you're not running your investments through an LLC or a partnership, you would have to set all that up. So it is, and there's a lot of tax requirements in terms of, um, making sure that you don't trigger taxation on grant or on vesting. In addition, right, if you are a member of a partnership, you're a K1 employee, right? So then you may be a K1 employee. So you may have an issue between being a W-2 or a K1. So all those things need to be kind of worked through before being able to offer a true carry or, a profits interest program.
Yeah, it's not so easy. It's not so simple. Here are a chart that looks at what are the other incentives to base pay if you are year over year not off balance sheet or a separate legal entity. And you can see that the shadow phantom synthetic carry has actually gone down. The corporate
Mhm.
stock stays consistent, and the corporate stock and the mix has gone up a little bit. So, and here is the on balance sheet or separate legal entity. That's where you can see. And so, Jessica, this is more
Mhm.
your experience. So talk to us a little bit about what, your experience with this and why and how you structure. I know you can't speak to exactly what's going on in your firm, but what the carried interest means in terms of a CVC.
So I think and again, I'm not speaking to any individual companies here that I'm familiar with of all their programs, but what I think this word of a shadow is the right one, which is how can you create incentives? Like potentially, there was a slide in there about that some of it is valued on the value of the stock going up, and some of it is at the exit. There are ways to actually calculate these, and so that there are potentially earlier bonuses paid on some of this to provide the incentive, so you're not waiting the full 10 years, and that's a benefit to be
Right.
able to do that.
How does that work?
Um, so I've been going to go back to Steve, like every one of these is going to be so different of how that it is that those are structured. But as an investor, what I want to know is that if I make a great investment and that opportunity is there and we're bringing the strategic value and and then that IRR, that there is an opportunity for my team and a team to be able to be rewarded on that, knowing that in certain structures there may not be the co-investment opportunity. And again, every entity is different in that. But without that co-investment, into that risk that an individual is taking, is there
You mean,
an adequate
capital contribution
yes,
for
yeah,
your
for
shadow phantom or
yeah,
your true carry, right?
right, yeah. So it's not apples to apples in terms of calculating a GP interest and a GP that you would be able to getting out of that.
Right.
But there are a lot of benefits in terms of some of that CVC side, in terms of strategic value. We didn't talk about at the very beginning, Jody, is some of the things that, there are fewer bankruptcies in companies that include corporate venture on their cap table. They actually have stronger exit horizons, et cetera, and all that exit data is really strong when you have them. And so you actually have a more stable portfolio also potentially through this. So, again, every individual has to weigh those pros and cons.
And I would say, sorry, just in terms of kind of liquidity, before the 12-year. So I think one of the strategies folks use is to do a deal by deal as opposed to doing more of a European waterfall, right? That takes longer to start paying out.
I have that data. Let's see.
Yeah, we've also kind of
Talk
looked
about
at
the waterfalls. I think that's been we've added that question over the years we added it recently for the VC on the VC side about here. Let me see. Here it is. Total VC real time. We have the waterfall data and it does come up. So I think you should explain to us what that is.
Sure. So when we say kind of a deal by deal, that's considered more of an American waterfall. So you can start receiving distributions. Obviously, there's guardrails around that, right? Because the other investments within a fund may not, may perform poorly. But that's one way to kind of accelerate, as opposed to the European, which is okay. I have to get enough proceeds from all of my portfolio companies in order to make up the capital contributions plus the preferred return before I even start to distribute anything to my participants. So that's the time horizon. I think there's a difference, right? Where you can accelerate. You can also find other ways to do it just based on the value of the investments. Again, I think you need to think about kind of how much of it. So go ahead.
Here's a slide also to maybe help you out a little bit. This is all from the VC data, but I love how it's we're weaving this in because this comes up all the time. It is really
Mhm.
important as a CVC to know what you're talking about on the VC side as well. VCs don't need
Mhm.
to know what they're talking about on the CVC side, but in order to stay competitive, it is important that you know, even if you know you're not doing it in terms of the talent and being able to speak to this, just what you're saying with the waterfall and Jessica, you
Yeah.
talking about, and I'm like scrambling back here because at the back of our deck was all the VC stuff, which we keep for these webinars just in
Yeah.
case we need it. And I love that we have it, but this talks about, is the vesting equal each year or does it change over time? And it just shows because Jessica, you're so good at this and you've been doing like made an entire career out of it, is that you have to be able to know about this language. And it's
Right.
impossible that the parent company compensation or HR people are going to. It is
Right.
incumbent upon you as investors to be able to speak to it and figure out how you're going to drive your organization.
And cannot double down on that more. And Steve, I know you do this. And not only that, this often will make it to the board level. And to be able to succinctly speak of how to retain individuals over time, and not just and again, the institutional, what you could be making on the outside, I think is
Yeah.
very important. And this will make it to this does make it to the board. And it does need, Steve, I know there's a lot of documentation around these, and that all that documentation needs to happen.
Right. And that's, I think, Jody, where we brought you in, right? Where the board, just in terms of being able to set compensation really does need to have a sense of what market,
Yeah.
and kind of what other folks are doing. So that is always, I think, something that, clients are looking for, is to have something to present to the board, so that, when they're approving these arrangements.
Right.
Because even if they know the answer, having data gives everybody comfort to know,
Yeah.
like it's in writing. And here's another chart that I think is really interesting from the VC side as we talk about Carrie, right? This is the vesting time,
Mm-hmm.
21, 22, 23, 24, and look at that 10-year plus,
Yeah. Mm-hmm.
right? And the 4-year going down and the 5-year going down and the 7-year is a little bit on the uptick and staying.
Yeah.
And the 10-year has had the biggest jump.
Yeah. This is exactly, eyes wide open. When you join an institution, you better want to be there for, especially if you want a long career. These are, again, I think I have the best job in the world. It is a privilege to get to do this type of work with the CEOs and the entrepreneurs we get to work with. But you need to be in it for the long haul. Those CEOs are relying on you to fight for them, to get them more capital when needed, et cetera. And so being in a platform that you feel like you can be at a long time is a really big part of this.
Yeah. Let's talk about the CVC carried interest in a little more depth because now we showed you the VC side a little bit. So here is and maybe Steve, you can speak to like we're changing this a little bit now because I feel like we should be saying instead of 15 to 20%, we should have we are adjusting this now because I think the 20% is a really important number. So the typical
Yeah.
VC side is an 80-20 split. So maybe give us the definitions around that and what that all constitutes and how it's different for a typical CVC as best you can.
Sure. Yeah. Yeah. So as you mentioned, the typical kind of in the VC fund context is going to be, kind of the 2% management fee, but also the 20% carried interest. So once, capital contributions are returned and hurdle met, then
Right.
the general partner generally is able to take 20% of the profits from the fund, and that is used to then compensate the various investment professionals. So, and in the CVC context, I think, there's a lot of pros and cons in terms of, kind of CVC. Usually, you've got a kind of better total rewards type of package, so you have other types of compensation. You don't have to go out and bring in investors. So I think I tend to see.
Difference. Although I think there are some CVCs that feel like dealing with the parent company is
Sure.
still,
Sure.
Jessica's laughing, but we hear this all the time that we make it sound so easy and it's really not. But and like in someone like an Echo, you have a lot of people like that who have table stakes, right?
Yeah. Yeah. And it may be harder, and for sure. Yeah. Yeah. But we tend to see either 20% kind of the starting place, but then we've seen folks go higher and folks go
Yeah, here's
lower as
the
well.
year over year, so you can see a little bit by the assets under management. So the less than 250 and the 250 plus. So what you had said earlier, our data really isn't aligned with that, that the more higher the assets under management, probably a little easier to have some more formality and structure around the carried interest.
Yeah, it's interesting. The kind of very first one, right, with 26% at under 5% for your carried interest pool. That's kind of indicates to me, okay, we're kind of dipping our toes into the
Mhm.
And then they find out this
compensating
isn't
folks this way.
sustainable, right? And
Mhm.
that's the other part about this. And I know, Jessica, you've had this in your career too. Just because you set it up in the beginning, and GE Ventures, may they rest in peace. Um, I know Sue Siegel, who ran that, they very high caliber, and I know that they had such incredible strategy around it, but it's different for each firm in terms of set up in the beginning and then where it ends up in the end, because as
Yeah.
you're successful, you become more sophisticated and more, I think, what's the right word, confident to require it to be differently.
Yeah, yeah. And again, there are definitely partnerships that fail on the institutional side too, in terms of VC structures and inability to really do legacy planning and transfer to the next generation of investors, et cetera. So they're all a little bit, not all the way to dysfunctional, but they all have pros and cons,
Right.
and they all have different strings tied to them. And just realizing what those strings are and the pros and cons of them are something that this data is going to be really helpful for
Well, look
individuals to
here alone,
understand.
the vesting times, right? The 10
Mm-hmm.
years smaller part. So, and Steve, you're shaking your head, right? So the vesting time for carried interest has not caught up yet in the CVCs. It's still shorter.
Hmm.
Is this what you're
Yeah,
seeing in practice?
yeah, I mean, it doesn't surprise me. I think, kind of your more standard vesting schedule is a 4 or 5 year vesting schedule, right, in the corporate world. So
Right.
it seems that CVCs kind of, I think employees may be more accustomed to that. I think if you go, to somebody who's accustomed to stock options or things like that, right? If you go to them with a 10, 12 year vesting schedule,
Mm-hmm.
Long.
that's not gonna work.
And here are the other components: a clawback provision,
Mm-hmm.
and then the cap on the maximum carried interest that can be paid out, meaning you can't make more than the top person at the company. And then how is it calculated, right? So this is it. Define cash limits. These are all the different components. And Steve, I mean, when you're working with clients, how does this jive with what you are implementing?
Yeah, so yeah, we will have clients that are very conscious about, and this tends to be larger clients that are very conscious about the investment professionals not making more than the CEO or other folks within the organization. Various caps are implemented as a safeguard, and others are, there's no concern about it. So
Right.
they're wanting to incentivize folks as much as possible and don't implement caps, but we definitely see a variety. Again, it depends on the individual organization and kind of the goals of the CVC unit.
I'm going to move in because I know we're sort of running out of time, which is no surprise, but I am going to show some new data on salary increase and bonuses because I know everybody likes to see what's been going on. So this is brand new data just pulled between yesterday and today, because it takes CVCs a little longer to report it because some of it has to be put in for year end and then not really put into place until the January, February frame. So here's 2023, 2024, and 2025 is, did you receive a salary increase for the coming year? And you can see that last year was a little bit challenging, right? Which we know. And then things moved up again for CVC unit leader nicely. The senior investment professionals, because they were so high and then went down, it leveled up a little bit. But again, this is all predicated on what the actual number is that you're earning. Senior associate and associate. And here is the year over year median salary increases as a percentage of base pay. No, and we see this in the private companies too, that 5% is about right. And some of the other, just to give you a sense of the lay of the landscape here, 2024 to 2025. And here are the 75th percentiles, because we know there's at least two of you who are on this saying that's not right. It was much higher. And you're right, that's the median. So this is the 75th percentile, which keeps everybody happy,
Mm-hmm.
right? And then here is the key factors, cost of living. And some of this more formality and structure from the CVCs has now moved over to the VC landscape because CVCs always had these kinds of questions on salary increase and bonuses, but I can assure you that the VCs now want to know the same exact thing. And just because somebody may be making $1 million, they want to also have a salary increase for cost of living because everyone cares about all this, or merit or performance based. And then I'm going to move from this into the key factors for the CVC unit leader. And then the last section, cash, right? No surprise with this instead of stock. And then the last section I'm going to go is on the hiring, and it's sort of a good way to wind up looking forward. We have a lot of sections we didn't get to, but I'm talking about how the corporate stock is structured, but maybe we'll have a minute to get this. So more so, do you see a change? And Jessica, when you think about your counterparts, I know went through the whole list of conferences and things that
Yeah.
you're to. What are you hearing around any changes coming between 2024, 2025, hiring people? You can see, yes, how are you looking at on the horizon?
Yeah, we're really seeing a bimodal distribution of the stronger ones continue to get stronger. That the
Right.
value is seen, the maturity is there, and that they're going head to head against some of the biggest firms out there that are and adding value to that. It's also a savviness of, again, bragging on Equifax, but structuring not just the investment, but how do you actually get the benefit from having a team like our EcoHealth Advisors team that brings something else. And then the ones that are dabbling, the tourists, we're really seeing those kind of go by the wayside. These are going to be lean years, especially with some stock performance and lack of exits. And so the ones that haven't performed, maybe we are seeing some changing. Yeah.
Here's some real comp data. So we keep everybody engaged for the last, they're keeping everyone on focus now. We try and show this at the end so that you feel like it's worth the wait. So here is current compensation data for those of you that are CVC unit leaders on the call. We have some other data that we'll show. And this data, I'm going to put the last pitch in. All these data tables come from the J.Thelander platform, and they can be customized by the job type, by the type of firm, by the total AUM. And everybody I know wants to see the data, the size of most recent fund. You can do it by location. So we can't urge you enough to participate because you do get access to a subset of the results for no charge. And it's a lot of data, and it's for a year because we've heard everyone saying we want more data and we want it for more time. So give it to you. We want you to be happy. And so you can see the base pay numbers, median 75th and max. The current bonus, which means it was awarded, again, median 75th and max. Target bonus, which is what's out on the horizon, and the total cash. And the reason why the base pay plus the current bonus does not equal to total cash is because you can see the sample sizes are different. So not everybody had a bonus as part of their total cash. Some people got to that just from base pay. And you can see that these numbers are getting up to the 1.2 million and the median at 430 because Jessica, you know better than everybody. And Steve, you said it too. First of all, no two CVCs are the same, and not all are created equal in terms of the role, in terms of the organization. And here are the total cash and carry trends, 22, 23, 24, and 25. Again, median. So this is the carried interest percentages staying pretty consistent. And then here is the total cash compensation by AUM, right? And we saw that the under 100 million and the 100 to 250 and the 250 plus, it's all staying about the same, but this is total cash, and this is not showing the relationship between the other long-term incentives. So we can't include those as a straight formula to add them in, if that makes sense. And here is the carried interest compensation again. So this is the inversion, right? The total cash is higher if you don't have a long-term incentive, and the long-term incentive is higher if you are higher assets under management. And here's a CFO, and then I'm going to wind us down all AUM. So here is a CFO, and again, you can see that the compensation, hang on, so I just got a call. So people want the data, you can go through this section here. Okay, so here's the CFO and the total cash. Again, you can see the percentages that are not tied to the exact base plus the bonus. And you can see the carried interest percentages. And here is the CVC partner versus a VC. Jessica, maybe you want to talk to this a little bit.
I think it's an interesting aspect. It, there are people who actually come to becoming into CVC not from an investment background, but from a corp dev background. Right. They've been moved from the corporate into this role and are learning it on the job. That is a potentially different base salary than one would come in from a VC to VC role, and it's just something to kind of keep in mind that whether you're coming from corporate in or not could actually affect.
It adjusts, and I know, Steve, that you and I have dealt with this on a client. It adjusts because when you hire the senior investment professional and they're sophisticated, then the CVC unit leader has to ask, what are we going to do? Because we know they start to see data like this and they say they're not competitive. So what happens?
Right, exactly. So then that's when we start having discussions. Okay, how do we, look at the total reward package to see, what the benefits are at the CVC as compared to the fund, right? To make that case, and then that's when we start looking at, okay, we need to come up with either a carry or a phantom carry program that is really going to satisfy that person and get them to come over.
Yeah, I'm going to show one last slide on the associate level. And this shows, for those of you that are more junior on the call, we want to make sure we give everybody comp data. So this is CVC versus VC. And this is where the market's really flipping tight, right? Because these people, the median total cash, 23, 24, and 25. So the VC stayed pretty consistent, and so is the CVC. But this is where the CVCs are a little lower, but the job is probably a little easier, a little less, more of a grind because of the lack of fundraising and the stability of, like what Jessica, you were saying, there's a lot of stability in these CVC roles. So what's your thought when you see this in terms of the different comp in recruiting people? What do you offer them at a CVC different than a VC firm?
Well, I think we also got to remember how rare the VC jobs. I mean, there's a rarity of jobs on both of those, but the CVC, I think you're looking at what Steve said around the total rewards in terms of and understanding. But we can look at all of those. I'm not that surprised that they're about the same, because I think people who are actually hiring in 2025 are more likely to have savvy programs who've been around for a while, because I think this isn't typically a job in 2024. People are starting new CVC funds in 2024. And so these are probably more likely to be experienced for new hires, if that's in that time frame.
Yeah, and the reality is that I think what you said is very important, and we're going to go and take a wind up here and to be respectful of everybody's time. But an associate job at a VC firm is really rare to come into, and we have done a whole study on the promotion times and how much money you make, and it is it's a little more cutthroat versus at I'm going to show this data real quick on the hiring parts for what part of the percentage of the current CVC team came from the parent company. And you can see that initially it's a smaller part, and then the less than 10, because you start to hire people from outside, and there is more opportunity at a CVC fund for these more junior roles. Coming at the top levels are a little trickier, right? And if you hire from outside the company, and that's a yes. And there are fewer jobs at the senior levels and more jobs at the associate levels. But I think it's really important, as we talked about, that you understand what the market landscape is as you're growing your teams and you're putting your infrastructure in place in terms of compensation, because this slide also shows where are people coming from, right? And they're for CVCs, and they're coming from other CVCs, and they're coming from VC firms. That's the number one place. So it's really important. And that's, I think, a perfect wind up, is that competition for talent, good people, is always competitive. And in times like this, when things are a little tighter, it's a great opportunity to take stock of how you're structuring, making sure that I was just saying this because we're really busy with the press right now and everybody wants to know what's going on. We have been in all of these publications and have interviews about data. And I feel like the ground is bubbling, and at some point it's going to go whoop, and we know that the markets are going to head in terms of the, investment ecosystem, because innovation is always valuable. And CVCs, as we started with, are, a huge part of this ecosystem. So with that, Steve, do you have a wind up? What's your number one, takeaway to let the folks on the call know you cannot go without doing what?
Sure. Well, I think, as you mentioned, reevaluate your programs. Even if you're happy with them, even if they're working, it doesn't hurt to understand, what others are doing. And that's part one. Part two is think about it from a compliance perspective, right? Tax perspective, securities law perspective. Even as you've grown, something that may have worked as a small CVC may need to be added and cleaned up as you get larger.
Yeah. Jessica, our
Yeah.
boss over here, tell us.
I would say, I said this before, but go in eyes wide open, truly understand, because the commitment you're making to your CEOs when you invest in them, when you back them, you do want to show that you're going to be there for the long term. And they need it. They need that support. These are hard to do. And this is a long-term game. So build the program for long term and do your investments for long term and build your reputation and the people you work with for long term. This is a great career, but take those steps to invest in it.
Great. Well, thank you all for joining us. We'll send a video from today as well as an email. So in case you have any follow-up questions, participate, because information is power, and we have great data here at J.Thelander. Thank you to Jessica and to Steve. Always wonderful to work with you. And you see how important it is that we all collaborate together. So look forward to staying in touch.
Thank you.
Thank you.